So let's call this meeting to order. So on the agenda today, I know as the approval of the minutes. Sorry, I set them late last night. The approval of the minutes from November 16th.
Motion to approve the minutes?
I second the motion.
Those in favor?
All in favor?
Aye.
Awesome.
Excellent.
You're up, Perry.
Chris, you have a doppelganger in Mount Lebanon, so.
Oh, really?
I drove by somebody today, I double looked, I thought it was you walking up the street, and then the only reason I know it wasn't Ellis, he was wearing a blue shirt, so, yeah. So-
Or he just changed his shirt.
An hour ago, I don't-
Yeah, well, I'm in South Carolina, so that, yeah, it wasn't me, but handsome young man, I'm sure.
All right, opening up to 1.1 per section. Fourth quarter finished strong across the board for the markets. As you can see, the S&P 500 came in at 11.69 for the quarter, allowing the year to be an extremely strong year at 26.29 for the year. The Russell 3000, which is what we use in your index and your benchmark, 12.07 for the quarter, 25.96 for year to date. So just a really strong finish to the year. Basically, what happened there more than anything else is the first two quarters of the year were pretty good, strong, positive quarters. But the third quarter, if you remember, was negative, took away some of that gain. And then the fourth quarter kicked in. The fourth quarter was the first quarter that the Magnificent Seven didn't totally carry the show. The rest of the markets pretty much came up with it, and that helped overall for the year in the domestic equity indexes overall across the board. Like I said, if you look at the Russell 2000 growth at the bottom came in at 12.75 for the quarter and 18.66 for year to date. International, very much a similar story. We used the third index down, that's the Morgan Stanley All World ex-US, 9.75 for the quarter, 15.62 for year to date. And then we dropped down. If we look at the fixed income markets, fixed income really kind of came through the way we were been waiting for it to come through. Once the Fed paused in the fourth quarter, left things alone, and it kind of became apparent that there was not any increases in the near future. I think fixed income, the ag, as you can see, came in pretty strong. Quarter to date, 6.82, year to date, 5.53. Flip to the next page. From an economic standpoint, too, numbers are still what I call mixed from a standpoint of, we've been talking about the mild recession, the soft landing, and it appears that, as data comes through, that might be where we're kind of gliding through right now, because we definitely have a mix of upbeat numbers and numbers that really didn't come through as far as what would come through with most normal recessions. So third quarter, for example, the GDP actually came in at 4.9. The fourth quarter looks like it's going to be good overall. Looks like GDP is going to finish between 2.5 and 3 for the year when they get done crunching the numbers soon in the year. Why is that significant? During recession times, you expect that to kind of drop down more, but the consumer side of things, they stayed confident, they stayed spending, and we believe the key to that is, from a standpoint, this is one of the numbers that has stuck out that didn't really change and typically does through a recessionary time frame, which is unemployment. Through most recessions, you'll see unemployment, adjust go up anywhere from say 3 to 7%, depending on how deep a recession would run and what's going on from that standpoint. Unemployment changed through this mild slowdown, as I would describe it, from 3.4 to 3.7. So it was at an all-time, high unemployment number, or I should say low, but if people employed it at 3.4, and then really they, adjusted to 3.7. So our point back to that is why we believe the consumer is staying strong and GDP is growing is one of the points is everybody's working. So people are still spending their money, from that standpoint. So with that, the one thing that we've seen that has been better for the overall labor markets is, at one point there was basically 2 openings to every applicant looking for a job. That is lowered down to about 1.4 to 1, and that's good because that has lowered some of the the pressure on wages. You know, there was a time frame there. We went through like about 2-year period now where, you know, the wages were going up so fast. That was a big driver to the inflation going up the way it did, was, you know, overall wages. So from that standpoint, we've seen some of that settle down a little bit, but it has been somewhat of a head scratcher that unemployment really didn't move, you know, through this process as far as a slowdown goes. Inflation, and this is the interesting piece, and the piece I keep repeating to my clients is, you know, inflation hit 9%. It is down to 3% essentially now. And you know, the Fed really, their goal is to try to get back to 2%. We've mentioned this before. Our concern was that they would try to get there too fast. They have seemed to kind of say, okay, let's see where we're at and see if this can kind of, that 3 to 2 is, you know, let's see if we can go gradually. But the interesting part of this, and I think this is what the everyday consumer, everyday citizen doesn't necessarily grasp, is, okay, we got inflation to come off its peak increase. That doesn't mean that the prices are going down. It means that they're, you know, if it's going up at 3%, at least it's not going up at 9%, you know, from a speed standpoint. And that's what I think a lot of people aren't grasping well, from an everyday standpoint, because it's almost like they're going to the store and they expect to see the prices drop. It's not that. It's more that they're not increasing as quickly anymore. They're at a more normal rate right now. But the one thing I noticed is the Monday after the Super Bowl, that morning they were doing projections of that the CPI would come in at 2.9. So the market was actually going up on that Monday. Tuesday morning, when the numbers came in at 3.1, the markets went down pretty significantly for the next couple of days. So just a 0.2 of a point kind of threw everybody into a tizzy. But the real backing behind it was, you know, the markets were putting so much on that the Fed wants to get into the 2s, that when they didn't get to the 2s, there was like an extra panic going on, you know. But from that standpoint, overall, you know, inflation's holding around that 3.1 area. So that's a positive. Unemployment never really increased. So from an economic standpoint, that's a positive. The area that we did see, you know, where we can actually put some data to and say, okay, there was a slowdown, is the chart on 1.3. When you look at manufacturing and service production in the US, and as you recall, 50 is the line where it's below its recession and above it is indicating growth. And you can see the manufacturing, the blue line did exactly what we expected as far as it did a true slowdown, dropped below 50, has been hovering down below 50 for last year or so. Manufacturing, you know, dipped below 50 for a brief period of time and has really been bouncing around between 50 and 55. But if you look, it dropped off its high of 67. So, you know, it's definitely slowed down. So, you know, maybe there's a new definition for service as far as when it starts to slow down, because it came off such a significant high. But we've seen the slowdown there. So we have seen, you know, less pressure there. We've seen that slow down. That's probably, you know, it overall has helped inflation from the standpoint of not as much pressure on the buying end of it and the supply chain issues that come with that. But as I said, it's definitely been unique not to see unemployment, you know, start to increase, you know, rather significantly. So now we're watching this from a standpoint that, you know, the beginning of the year, the markets were pressuring the Fed from a standpoint of, you know, 3 rate decreases this year, and starting in March, the Fed was pretty quick to come out and say, you know, whoa, slow down. You know, we're looking at this. We are considering, you know, that we would possibly decrease the rate, but most likely not going to start till June. They still want to gather more data. You know, the Fed's, I think, doing a good job from the standpoint, if they're looking at it from the standpoint of, they definitely don't want to take, you know, 75 basis points off the rate and then have to turn around and put it back on. You know, so they're trying to, you know, walk the tightrope is the way I would put it through this. And so far, you know, it looks like, at least from, you know, the mild slowdown that we've had, they're walking it the way they want to at this point. So, you know, those are the areas we're watching. Obviously, this is an election year. Typical election years, markets are somewhat, you know, flat is the way I would describe it. There's not a lot going on, at least until after the election. And then historically, if a Republican wins, markets tend to go up. If a Democrat wins, markets tend to, you know, be more volatile at the end of the fourth quarter. But, you know, that's historical. We'll see how that plays out, because I would say if some of these other economic numbers have actually started to move up and the Fed does decrease the rate even just a couple of times, you know, by the end of the year, that would most likely, you know, get things kicking, and that might create where the market actually ignores the election, for example, and just kind of goes more with the economic data. So we'll see how that plays out. Our view is if they start in June, that there's a good chance that they probably maybe get 2 decreases in, but not necessarily a third cut. That third cut might come the first quarter of 2025, but it appears that we're going toward that place that somewhere in the summertime, they'll probably do a cut. That's what it really looks like at this point. And that's the interesting part too, a couple cuts, not a bad thing. If they, for some reason, start to feel themselves racing back to zero, that's probably really overall not a good thing. There's like that, I've always said there's somewhere in there's gotta be a happy medium, and we went through almost a decade where they sat at zero. And I'm sure historians and economists will look back and say, that was 3 years too long or 4 years too long of staying at zero, but it'll be something they call later, But there was definitely a push there as to, staying there as long as they did not help. So just move into the back couple pages here in section 1.9. Overall, just giving you a feel for like our outlook and what we're looking at from the markets over the next, say a couple quarters right now at this point. Our overall view is equities are definitely in a position to do, fairly well. I wouldn't say not nearly as well as they did in 2023, but we do see the potential for positive returns in the equity markets. Large cap wise, we're somewhat neutral there. We feel that, a lot of that was gained in 2023. Where we are, where we do see some more potential for more positive returns are in the small cap and mid cap. And that is if the rates get cut a couple times, 2 to 3 times, by the end of the year, that'll open up lending a little bit more. That'll help the larger banks and the smaller banks in general, because the banking industry is definitely not lending right now. They're tightened up, very much so. But with that, small and mid cap companies tend to depend on borrowing a little more to help, stimulate their growth and expand. So if lending opens up, and by the end of the year, we see small and mid cap, coming through a little stronger compared to large cap. International equity, similar story from the small cap end of it. We see more potential there because if the Fed cuts rates here, most likely Europe will cut rates, and that'll still start stimulating for small cap. Where we're somewhat neutral is the developed markets and emerging markets, and that's twofold. Developed markets did really well in 2023 as far as the way they finished too, similar to large cap in the US. So we expect maybe less there. But the other thing is all the international pressures going on right now, that from a geopolitical standpoint, we're concerned it could throw the European markets and emerging markets into, a tailspin rather quickly. So from that end, that's the years we're focused on. From fixed income standpoint, we're still neutral on a duration standpoint. It's just because we're watching the rates and seeing where the Fed goes. So it'll cause a little bit of turbulence there, depending on which way they go. But in general, the rates at a spot where from a long-term standpoint, starting to pay off. We saw that in the returns in the fourth quarter. But overall, where we're a little more positive, it really is in the credit sensitive area. That still seems to be the area that gives us more advantage to add a positive part to the portfolio. The next page, 1.10, same kind of concept, just give you like areas that we're looking at over the next 6-12 months. Well, we're always looking at it, but our outlook right now, monetary policy, we're somewhat neutral, waiting to see what the Fed does next. Economic growth, we're neutral to sliding to positive because we see the numbers from the GDP standpoint. We see the fact that unemployment really has not gone to a bad direction, that we're starting to see that definition of a mild soft landing, I guess the way to put it. Inflation, we're positive there from the standpoint it is hovering around 3. We're not seeing it climb back up. It just is staying in that area. We believe from 3 to 2 has got to be a slower process anyway. So those areas are good to us. Our biggest key here is political risk, and I mentioned this earlier, but the best way I can put it is if we can make that red even deeper red, we would. I mean, it's not a good situation right now between China's, eyeing up Taiwan, Russia in the Ukraine, and then the war in Israel right now. There's just, too many hotspots, I guess the way to put it, and too many of them that could definitely disrupt supply chain issues. I mean, as far as that goes. So, and like I said, if any of those areas really heat up to where totally out of hand, which it's hard to say that they're not already out of hand. But from that end, it can really disrupt things in Europe. And then, the US will probably fill that last, but it will trickle over. There's no doubt about it. But that's why we're a little more concerned for emerging markets and internet and developed markets in Europe. So with that, I'll go into your portfolio performance in the next section. Quarter overall relative basis was good returns for the quarter for your portfolios. At the top is the police plan. You can see it came in at 8.84 versus the benchmark at 8.53, bringing in the year at 14.04 versus the benchmark at 14.91. So on the calendar year basis, underperformance, but for the quarter, good solid performance, good solid outperformance. Interesting there is the fourth quarter it was good to see the outperformance from a standpoint of we moved into a more defensive positioning from an allocation standpoint back in the middle of 2022, and we have stayed there. We're staying pretty much right on target. So getting out performance in that type of time frame is good to see in a quarter, but I believe that's somewhat why you see the underperformance for the overall calendar year is that we remained in a defensive position because we were more concerned about the way the third quarter went last year. We thought we felt we would see more of that throughout 2023. And fortunately we didn't, from a standpoint of overall return. As you go out to the longer numbers, they're sitting in good shape. Your 3-year numbers at 3.15 versus 3.02, 5-year number at 8.77 versus 8.61, and your inception to date number dating back to 2003 is 7.2 versus the benchmark at 6.84. Why are those last, 3 sets of numbers so important is staying above 7% for your actuary future, liabilities is vitally important for the plan, and those long-term numbers spell that out for us. So that's all good, solid numbers from that end. Each plan following similar type of numbers across the board. You can see the employee plan came in at 8.79 versus the benchmark at 8.53 for the quarter. The firefighters came in at 8.78, and the OPEB trust came in at 9.76 versus its benchmark at 9.71. Long-term numbers pretty much across the board reading the same way. If you go out on the employee plan, 7.23 versus 6.84 for the inception to date numbers. For the firefighters, 7.2 versus 6.84. And for the OPEB trust going back to 2016, 8.23 versus the benchmark at 8.05. Just a couple things to point out in the actual police plan from a performance standpoint. That's section 3. Something I want to point out, page 3.4. 2022 and 2023 were not the greatest years for us from a relative standpoint. But I was looking at something that I found interesting. We had a 5-year stretch where we outperformed the benchmark every year on a relative basis, and that goes back to 2017. So 17, 18, 19, 20, and 21 were all outperformance. I guess when you think of it, we were due for a little bit of a downturn. From that standpoint, so we 2 years in a row from a calendar standpoint, a little rougher performance on the relative side. But I think the positive here is from a standpoint of pretty strong return bounce back in 2023 in general. Getting double-digit returns coming off of the way 2022 went will help, as we were talking before the meeting started. It'll help from the standpoint of spreading your actuarial report out, spreading some of those numbers out will help your funding status. Because you're at a very healthy funding status, so it shouldn't trim too much off of it when 2022 starts to really affect the numbers, because 2023 will help balance that out rather quickly. So with that though, I just wanted to kind of point out that very good stretch of 5 years in a row of the strong performance. And so with that, when we go to page 3.7.
Hey, Perry, one question.
Sure.
So the net or the performance that's shown on, I guess, 2.1 and then
Yes.
1.34. So is that net of management fees?
That's net of all the management fees except for our fee.
Except for your fee?
Yeah.
Okay. And what is the fee?
Our fee averages right around 18 basis points, I believe.
Correct.
Yeah,
Oh, okay. All right, perfect. Thank you.
But then you net it out of the fund.
right. So that piece comes off. So it actually lowers.
Perhaps lower.
It lowers it, I would say, probably. Is it safe to say around 13?
we weren't even paying anything for the majority of the year,
Okay,
so.
so hey, it's netted out really well for you.
Yeah, I would say so.
I'm not gonna mention it.
They made a concerted effort that when they went to the PFM managed funds, that they don't double dip.
Got it.
And so where that comes out is we actually have gotten a credit back, cash back from PFM saying, hey, we already took it in the fund. It did, you know, however the calculation worked, and we actually got money back.
Okay.
So they're not double dipping, and it's accounted for every time.
Yep, okay.
On every bill.
Yeah, and it's a monthly bill, so you gotta see it.
I see the monthly transaction.
The interesting thing about it too was, and we knew this when we were doing it, but it was hard to relay to our clients, is in the beginning, that initial rebate back was smaller because the assets were growing.
Mhm.
So we've hit like what I would call a very comfortable level of assets where clients like yourself are getting, you know, basically, you're almost netting out to zero because we're taking it in the fund.
Got it, okay.
So,
It also helped that when the RFP came out and we did the whole thing, we started at 15 basis points, went slightly up to 18 basis points, and it's worked well. So
Yeah, okay,
definitely.
good.
and the one thing, at least since I've been at PFM, which is now 8 years, we don't increase rates. You know, like, I mean, we haven't in 8 years.
Yeah.
You know, so it's kind of it's a good thing in general, right? I like it because I don't have to get hit in the head. That's just me. So,
Understood.
yeah, so, on 3.7 is, I call it the hard dollar report, but just to give you a feel for the quarter, what did that, very solid return mean for you? It meant a hard dollar return of 5.9 million. And then for the calendar year, that double digit return from that standpoint, meant a hard dollar return of 9.1 million. So you started the year at 65 million, finished the year at 73 million. I'm rounding off, obviously. But it was a really good bounce back. You know, the markets kind of gave back, you know, let's say 85% of what they took away in 2022, which is a good thing. Typical downturns in markets, like if you go back to the financial crash, it took almost 3 years for people really kind of get their money, you know, to get back to where they were when that all started. We're on pace now, say 15 months in from the down point of the third quarter of 2022, and you're almost caught up on a dollar to dollar basis as far as what was lost. So that's pretty good. Matter of fact, I would say another positive quarter or two and you'll be past. You know. So the way I would look at it is it's almost like we're on pace for, like, say 18 months to get back to where you were. So with it, that's all, that's the good news from that end. Page 3.8, just to show you, the box at the bottom is, basically your allocation targets. And as you can see, pretty much right on target, as I discussed, and we've been maintaining that. And then that's so far outlook from our investment committee. It looks like we're gonna stay in that area. There's not that confidence level right now to kind of put a risk on type of format and, overweight in equities in any area. So we're pretty much, on target across the board. Fixed income's interesting because, for years, up until about 2 years ago, we were always underweighted fixed income. I'd say about 5-6% on average, and we have increased that over the last 2 years with the rate going up. And, that's always good because we consistently see returns of, 5% in the fixed income world going, if we see that going forward, it's kind of nice knowing that you have 28% of your portfolio coming in with that type of number. So, that's why we're pretty much on target in that arena.
My only, excuse me, Perry, my only question, this is my last meeting, so I want to make sure I get it on record. Is that, 21% allocation to international equity. I know our range is 1 to 41, and I know hindsight is such a wonderful thing to have. But international equity has significantly underperformed US. That's obvious. But when you look kind of going forward, with the politics globally, and you put that as one of your highest risk categories is international politics, And it's not just like wars and skirmishes going on, but it's the more of a socialistic agenda that's taken over in several of these countries, such as Germany and France and Italy and Spain, etc. And then the really communist, um, strong arming going on in China. It's hard, when I look at 40% US and 20% international, it's just personally hard for me to see, why I would want to have that much international. I know that, again, there is maybe reversion to the mean, etc. But when you look at the companies that are growing, you look at the regions of the world that are growing, almost every new business is started in the United States. You look at what's going on with artificial intelligence, etc. There's very, very little activity going on internationally in that regard, other than China, which is, basically government run.
Right.
So I don't know what the right number is, and maybe 21 is the right number. I don't know, but I know as soon as if you were to cut it to 15 or 10, international would have like 3 great years in a row. But it just, when I look longer term, still, I struggle with the weight, basically 1/3, 2/3 kind of, US domestic versus international.
I will tell you, the investment committee is wrestling with that every day, if that makes you, feel any better, but that is a concern. They have the same concern, and actually, almost to your point, kind of the chuckle point too, but that is some of the concern too, is, right now, we have these lined up with where we feel markets are across the world. But, there is a little bit of that, there's some risk there that should we be underweighting. And then there's obviously that, if we change the target altogether, are we gonna look back and say the next, watch the next 3 years, go through the roof? But it is something we're looking at every day. For instance, in that 21% is the emerging markets, and that target is typically 6%, and we're lower there. We don't show that in this, we just show the whole, but we are lower in the emerging markets because that's where there is more concern. But yeah, no, Chris, I would tell you that's probably the lead topic in our investment committee every week.
Mm-hmm.
It's definitely,
Okay.
You're right on point with what is probably our largest concern.
Yep.
I'm not sure which direction will take us, because I do believe there's a bit of that, if we're looking at the world the way it breaks out, we're fitting in, and we're lining up the way we want to line up. So, do we alter that, because over the long term, there's confidence of where that will be down the road. But no, there's no doubt that's the lead topic.
Yeah.
There's actually, I'll give you the top 3 things going on in our investment committee today. That international issue, we're looking now at, we've always had core managers from an active standpoint in our portfolios. We're actually giving strong consideration to going to like a value and a growth manager. Our issue though is, one of our beliefs though is not to add the risk of trying to, overweight growth versus value. So that's why core always made, more fit into our philosophies more. But we're looking now at ways of adding a growth manager and a value manager, and just guiding it to pretty much be equal all the time, no real overweighting. One of those reasons why is domestic equity is a great example. It is so hard to find a domestic equity large cap manager, especially, that can outperform consistently. But we can find them in growth, and you can find them in value, that they can actually outperform their respective relative benchmarks. And so we're starting to look down that path. So that's something else that is very much on topic for our committee. Those are really the top 2. And then actually just overall manager evaluation and where we're at with it. Because when we look at, where we have seen the dispersion over the last 2 years, it's been the active managers that have actually detracted from the portfolio the most. Allocation wise has been the only area that's actually really added value. And we would tell you that's our expectation typically anyway, is that where you add value is your allocation. But you also don't want your active management process to basically be, the key detraction, So those are like the top 3 things that we're, constantly on top of right now.
Well, those growth managers, I guess, unless if they had an equal weighting to technology, then there's no way they would. Equal weighting to the index that
Right.
there's no way they would keep up, right?
Yes, yeah, exactly. So it's, but like, that's why, so we're looking at that, from that standpoint, because, 2023, really coming out of this, right? The Magnificent Seven, that whole issue, like, to see that quarter after quarter after quarter was really, not a norm, I guess, is the way to put it, right? And even, all this over AI right now, and you figure we're pretty far away from probably seeing a lot of this AI truly pay off, and it's just interesting how already, if you watch advertisements, certain companies are already trying to cash in on, what they're gonna bring as their version of AI and how they can help you, right? So you already see it out there. We really, is it really there yet? So, which, typical, right? Markets usually start to react before, or, get involved in growing that before it actually comes through on the anticipation of it. But yeah, those, to me, those are the 3 areas that we're focused most on. From an investment committee, every time, those are the key topics that come out of our meetings. But I think your point to the international, that is the one that probably weighs the heaviest because of that feeling of like, if we adjust this at all, are we gonna hurt our clients? In the long term.
How long has international equity been at 21%?
That's been the target for the last 6 years,
Okay.
7 years, going back to 17. So
Okay,
going back to 17.
what was it before 17?
It was 19.
Okay,
So I think when we made, I think that sounds right. I'm looking for these targets real fast. No, I'm sorry, back in 2008, we still had 21, so 21 has been consistent. So so it's gone for a long time after 21. What I was thinking about is we were underweighted for quite some time and we were hovering around like that.
20, yeah.
So we were underweighted that target.
Yeah.
We went up to 23%, and came back down to
And
22.
it went back down to 21. Yeah.
There was a 7-year period where 6.5-year period where we were up.
Right.
We'll come back down to 21.
Yeah, we did that back in 2000.
I think I asked this before, the international is not hedged, correct, to the US dollar?
Correct.
So inherently, you would have a little bit of a safety net, if you will, with the international investments, if the dollar takes a hit, which a lot of people are thinking is going to happen at some point.
Yeah, I guess.
Yeah.
I wouldn't expect it to be much of an effect. Anything from an overall standpoint, but yeah, there would be some hedging there.
Sure, okay.
But yeah, that's right, because in 2022 is when we took it back down. Any other questions? If not, Chris, I want to go down the street and talk to your doppelganger.
Sounds good. Buy him a coffee.
All right. We else have anything for the good of the order? Well, I do want to personally thank everyone for being on this board. As you know, it is coming to an end. All good things must come to an end. As much as I could, I tried to keep this board in line, but it's not part of the comprehensive plan. So the comprehensive plan was to fold this into the financial management board. So we will be meeting there. As I told you, John, there's only two boards that meet in the morning, the Economic Development Council and us, but now it'll be a 6 PM meeting every month. So we'll see how that goes, but I do want to thank you. And if a board of the Financial Management Board does not interest you, maybe another board does. It is important that we have those people inactive on our boards. And it's been nothing but good for the municipality. So that's where we're at, and off to the Financial Management Board. Here we go.
It's official.
So you're meeting at 6 o'clock in the evening monthly?
Yeah, so we'll call for adjournment at 9:43.
I make a motion to adjourn.
Awesome. Thank you, Chris. Enjoy the sunshine.
Thanks, guys. You guys take care.
Yeah,
Sunshine, we had sunshine here yesterday.
it's nice here today. I'll take storms.